To the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now, here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome back to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, the main man of the hour, AJ. Welcome to episode 96. How are we feeling today, AJ?
I'm good. How are you doing, Sip?
I'm doing good. The first thing that caught my eye on your notes today was that the week has been a roller coaster, and I feel like I agree. We're getting information from all over the place. And so, is it good? Is it bad for the markets? It's obviously good for us options traders, but what is the overall trend? What is sticking out for you this week?
I mean, the overall trend is sideways choppy, but let's delve right into the economic news because this week was a good economic news week. Let's first take a look here at consumer confidence that came out on Tuesday. When we take a look at consumer confidence, let's go ahead and click on it. There we go. Consumer confidence came in a little bit softer than it was expected to be, which this is a case where bad news is sort of good news, because if consumer confidence starts to drop, what that means, of course, is that the Fed may be less likely to increase interest rates because things are working. They want things to slow down. And so then if we go ahead and back it up a notch, if we look at Wednesday we got some, and by the way, on Tuesday, we got some great news from companies like Tesla, NVIDIA, and Alphabet, the parent company of Google. And in fact, the deal between NVIDIA and Google kind of really boosted both companies. So people were very excited about the individual tech stocks really gaining some foothold. Then we take a look on Wednesday. We got our GDP numbers, and check this out. Remember, the GDP numbers are reported every month. They're reported first as a preliminary, and then those little analytics scientists go back and check their work, and they come back and they, I should say, they first report it as an advanced report. Then they come back a month later and say, okay, we've checked our numbers. Here's the preliminary numbers. And then they come back a month later and say, okay, we checked it a second time. Here are the final numbers. And then they go ahead on to the next quarter. So we're still talking about quarter two. This is the second revision. This is the preliminary revision. And what you'll notice here is that it's a lot less than they said in their advanced numbers. Came in at 2.1% growth instead of 2.4% growth. And so that gave, again, this is a case where you would think, oh, GDP numbers going down, that's bad news. But bad news might be good news as far as future tightening. So that gave investors a little bit of confidence. They were like, okay, I think this could be evidence that what the Fed has been doing has been working. And then let's go ahead and back it up a notch here. And then we got, what did I want to point out? Well, we can look, I think we have to take a look at the personal consumption expenditures numbers from yesterday. So this is that favorite indicator of the Fed. Now, the personal income, right? Because we're always trying to balance how much people are making versus how much prices are growing at the markets. So personal income grew 0.2%. That was below expectations. And 0.2%, if you multiply that by 12 months, that's very close. That's 2.4%. That's very close to what the Fed target rate of 2% is. You take a look at personal price or personal consumption expenditures. Now that number does look high, right? 0.8%. And that kind of freaked people out. But then when you delve down deeper and you look at the price index and then the core price index. So these are prices of stuff that aren't as volatile, like fuel and food, right? It comes back down to that 0.2% number. So this kind of caught people off guard yesterday, this 0.8% number, but then the 0.2% number came in quite good. So people were a little bit mixed yesterday. Now let's look at this morning's employment numbers. Give it a second here to load. There we go. Pull these up. Now this is a mixed bag, but I think mostly it's good news. So first of all, the one survey that they do every month, it shows that right here, 187,000 jobs were created. The consensus or the expectation was 170. So that's positive news. It means that jobs are still being generated out there. We look back at last month, and when the little number crunchers went back and revised their numbers, they actually revised them quite lower, right? 157,000. Then they do a different survey, and this is, again, bad news equals good news, maybe. The employment rate actually spiked up. Unemployment rate actually spiked up to 3.8%. So is that good? Is that bad? Short duration, it's bad news, but for future tightening, maybe it's good news. But here's the number I take a look at, and that's the average hourly earnings, right? And this is month over month, because I'm not really going back a year, not right now, because the Fed did so much activity that hasn't filtered through yet. So by going back a year, you're getting kind of data that is skewed. So I'm looking at the month and then multiplying by 12. And so the month is 0.2. And so that comes out again to that 2.4%, or very close to that Fed number. I'm also looking at the work week. The work week is getting longer. Participation rate is getting stronger. Manufacturing picked up 16,000 jobs. This is really positive news. And I think that the market, whatever negative sentiment they had yesterday, will be outweighed today. Overall, I think that this is an interesting time, but a lot of eyes are focused on what the Fed is going to do next.
And is that the main driver of any of the overall market moving up? Is the market starting to get a little tired of all of these rate hikes? And we need the slowdown to basically say, hey, let's just keep them here for a little bit and hope the inflation doesn't spike, because isn't that the main reason why they continue to raise the rates, is because the inflation is up?
Right. But I think that what we saw over and over, and it's not consensus, it's not 100% of the data that they've got. There's still some sticklers out there, but for the most part, we're seeing that the Fed is seeing that their tactics have been taking through. Still, there is there's this sentiment that in September, the Fed, well, let's take a look here. It says the Fed is probably not going to do anything in September. And that's kind of what we expected. But the question is if we go out to November, it's getting less and less belief that the Fed will do anything in November, right? Before we were seeing almost a 50-50 split, and now it seems to be more like 2/3 saying that nothing's going to happen in November versus 1/3 saying that there might be a 1/4 point rate hike. And then if we look at the middle of December, right before the winter holidays, again, the majority of folks are saying that there will be no more rate hikes. So there's kind of this sentiment that the Fed will stay on hold for the rest of the year, but I wouldn't put a lot of money on that. It could be totally possible that the Fed does another 1/4 point rate hike. I mean, they're playing it month by month, as should we. There's one other tool, and that is remember, they sell their bonds, and they're almost down $1 trillion from their all-time highs. So if we take a look at this most recent number here, let me go back about 6 months. Let me go back a whole year. Let me go back even a little bit further than that. So here you can see their peak was up here around 8.9, almost $9 trillion. And now we're down here at 8.13. So we're getting to the point where we've shaved off a whole trillion in the cash that they created during the COVID crisis. They've shredded almost $1 trillion. But when we look at the bigger picture, Sip, let's look at all time here, and let's pull this out and perhaps just focus in on what happened from the COVID crisis on. So you can see here, we're up here. I mean, they really would like to, and they said that they were targeting 2026, 2027, but I think that it might even go to 2030, assuming nothing big happens between now and 2030. For them to get back to the level that was the pre-COVID crisis. I mean, if you think about it, even at $8 trillion of the Fed holding our debt, that's double. Can you imagine if they just overnight, as fast as they injected the cash into our economy, for every dollar you've got, you're asked to give half of it back so that they can shred it? Because that's really what they're focusing on, little by little, shredding about half of our circulating currency. That's what this means here. And they're doing this behind the scenes, but this is also another kind of tamp to inflation.
And in layman's terms is by bringing this number down, that is fighting inflation, right? Part of the reason that we had such high inflation is this exact printing of dollars, right?
I mean, it's a huge contributor. I mean, they flooded the market with a ton of cash. They had to, because there was nothing happening, right? There was no movement of money when everybody freaked out about the pandemic. People were not going to work. There was nothing happening. So they had to keep things moving, and they did that by printing money off. But at the same time, so they basically floated us. They gave us a big giant loan, which was good in the short term, but in the long term, you know, what did people do with their money? And that's a whole nother discussion. So now they're slowly, you know, taking that money out of circulation. The question is how are they taking it out of circulation? So this is another tool that they're using. It's called the quantitative easing tool, and it doesn't get as much focus, but basically the Fed, with their funny money, the money that they printed during COVID, is now the biggest debt holder to the United States.
Interesting. Let's review the markets real quick, right? Mm-hmm. Because we do have this roller coaster news week, and we've been over pretty much all summer long. We were taking little steps towards highs, and I mean not all-time highs, but we're definitely creeping up to the highs. We had somewhat of a pullback, maybe mid-August, right? And it's, you said sideways action. Is that what we're seeing now?
Yeah. So this is really interesting. And by the way, I was featured on a weekly program that actually had their 400th episode, 9-year anniversary. They invited me to be on that show. It was called the Crowd Forecast News. And I was on there with some other trading teachers that I've known for almost 2 decades. And what's interesting is they asked us what our consensus for the end of the week is. And I'll tell you, I was the only one, based on my retracement analysis that we have on the screen in front of us, I was the only one who said that the market would be up by the end of the week. The other 3 were thinking it would be down by the week. So I kind of pat myself on the back that I have a clue on what's happening here. But because these are some really seasoned traders, I know that they're quite successful. With that said, so yeah, we had the beginning of the current price action starting back on July 8th. And we really didn't know that until we got confirmation of that, not until the middle of August. So we thought for the longest time that we were on this uptrend, but then we got hints that this uptrend was under some stress in the beginning of August. And by the middle of August, we were like, you know what? It turns out that we've actually been secretly starting to go sideways, if not down. And we weren't sure, but now I'm sure. Here's what happened. When we had this pullback right here, starting on July 31st and going all the way to the confirmed closing bottom on August 18th. This closing bottom surpassed the most recent move that we had. So that kind of ends that uptrend that we were in. But in addition, it fell short of what we would expect a downtrend to be. It fell into a range that would be more characterized by sideways movement. So the question is will that continue? So we've already been on our move. We call this a range contraction move because now we would think that we would be in a downtrend. And so whenever you have a move that's opposite the overall kind of medium to long duration channel move, you call that a range contraction. And so this range contraction move, if it was going to be a downtrend move, it would have stopped in this pink zone. And as you can see, as of the Wednesday, it for sure didn't stop in the pink zone. It went into this orange zone. So this orange zone is where we would stop and reverse back down if we were in a sideways choppy market. So now we've got our one move down here that gave us belief that we're in a sideways choppy market, right? And now we already know, because we missed this pink zone, that we're in a sideways choppy market. So we've got two moves here. Get a couple more of these moves, and I'm going to, my confidence right now is through at least the fall season, if not into the winter season, we're going to have sideways choppy. And my confidence is about 60% right now. But if we get a couple more moves like this, my confidence will be more like 80% going all the way into the spring, that we're just going to kind of hang out here in this zone somewhere between about 4,350 and 4,600.
Well, fortunately for us, as options traders, our goal or our strategies and the tools that you use and the community uses gives us an opportunity to take advantage of sideways choppy, maybe a little bit to the upside, a little bit to the downside. And that's exactly why we have the show. That's exactly why you've created the program. And that's why we're educating the wonderful audience, the viewers, on how to use these tools and make some money and incorporate it into your investments. And so we've got plenty of show ahead of us. We've got your pick of the week. We've got our trending topic. We've got our speed round. But in the meantime, we would love to invite everybody to AJ's daily workshop. He's got a wonderful program that he puts on where he reveals 4 strategies to essentially using options almost like a monthly, weekly paycheck. And so if that's something that you're interested in learning more about, head on over to the link that we just put into the chat. There it is. Check it out this weekend. Check it out later today. It'll be there for you. We'll be coming back with our trending topic. We're going to take a little bit of a break. Stay tuned, guys.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right, AJ, back to our trending topic. And so as being an educated in the space for almost 20 years, if not hitting that 20-year mark, what is your advice to new people who want to invest, want to be involved, but maybe have some sort of limitations, right? Whether they have a day job or they don't have access to the fastest internet, and there sometimes there can be limitations. And so the trending topic for today is finding or trading the markets in a way that's right for you. And so what is your approach? What is your advice that you would give to someone who's looking to get in, but maybe is hesitant because of these quote unquote limitations?
Well, and the reason why I wanted to talk about this today is, interestingly enough, I don't usually catch some of the different shows on the television, but we had Mad Money running on in the household. I think it was Wednesday's episode. This was the Jim Cramer show on CNBC. So if you have access to cable or any way to check that, I would say go take a look at this Wednesday. So his whole emphasis, and it's something that I'm glad that he brought up because, and I'm glad that I caught the show because I have been echoing this for forever. The story that he told was when he was very young, before he got his claim to fame job at Goldman Sachs, what he used to do on an answering machine. So these were boxes that people would buy because the voicemail on the cloud wasn't available yet. So you had your phone mate at home. He would actually in the mornings record a 40-second kind of blurb on what the markets were doing and what stocks to be interested in. And people would call his home phone to listen to this voicemail, to this answering machine message and get those picks. And then he interviewed and he got the job at Goldman Sachs. But he continued to do this on the side because he would have like 100 to 200 calls a day into his home phone to listen to that voice message. And his boss at Goldman Sachs caught wind of what he was doing on the side and brought him in and was like, dude, who is this for? And, you know, as a young guy, he said, you know, my advice is for everyone. He's like, no, seriously, who is that stock pick for? And he's like, again, I think that this is for everyone. I do my research at the library. This is before the internet when you had to go get microfiche films and look at it in the library and do your research, and all your data was 6 months old because that's as fast as you could get it. You couldn't get it at your fingertips. I can't even imagine a time like that. And the guy said, listen, what might be right for you and what you're researching might not be right for everybody else. Everybody else has a different risk appetite. They have a different situation going on at home. And the difference is like when you buy a home or a car, you wind up paying extra for insurance. So if something happens to your home or to your car, you can get your cash back out. Or if you buy something like at a Best Buy or a Macy's or a Costco, you can take that back and say, I don't like it, I don't want it, and you can get your money back. Even Amazon, you can call them up and they'll either have you keep the merchandise or they'll have you send it back and you can get your money back. No harm, no foul. But you can't do that in the stock market. You buy a stock and it goes down. You can't go to anybody and say, I want my money back. So you got to be, you know, the point is it's almost a crime if somebody's just spoon feeding you picks and saying, trade this. And you are kind of believing that because it might not be right for you, right? You need to take inventory of, number one, not only what your wishes and your wants are, because a lot of us get big eyes when we read, for instance, some marketing around joining a service, and they talk mostly about rewards, which is great. But we get our big eyes thinking about what the rewards are, and we don't think about what the time investment is, what the knowledge investment is, and what the risk appetite has to be to do that, right? And so, you know, you sign up for this. Sometimes you pay just a little bit amount of money. Sometimes you pay a lot amount of money, and you don't really know what you're getting into, especially if they're just handing you picks, right? Because the picks may be right for them, but not be right for you. So in addition to wanting to know what your wishes and your wants are, you have to take a good inventory on who you are and also what your situation is, right? Because a lot of the folks who come and follow us here at Trading Trainer, either we're really family oriented, right? We've got a lot of, you know, we want to emphasize spending time with our loved ones. And or there's a lot of professionals, right? So folks that have prioritized their career. We've got doctors and dentists who, we have like an emergency room doctor who, God forbid, if he got a day trading signal on his phone, he wouldn't be able to stop what he's doing in order to go do the trade, right? That's just
we wouldn't want that, right?
No, absolutely not, right? We have dentists, we have lawyers who can't leave, we have trial lawyers who can't leave the courtroom in order to go place a trade, right? And we've even got like a bunch of folks. My favorite guy is John, who climbs around in big giant corporate buildings like skyscrapers, ducts, the HVAC units. He's climbing around the ducts inside these buildings. I can just imagine his phone vibrating in his back pocket and him trying to reach and not being able to because he's in this tight little duct, right? Air duct, trying to figure out how to trade this in the dark. Yeah, that's not going to happen. And then we also cater to folks who just want a certain lifestyle where they can do whatever they want to do, right? And so their passion might be golf, or their passion might be some sort of recreational thing. And the last thing they want to be doing is focusing on there. So you got to take inventory of what your situation all is, and as well as what your risk appetite is. If you're kind of young, right, and you're in your mid 20s, maybe your risk appetite is much bigger than if you were in your 60s or 70s planning for retirement. So you don't want to be doing something in your 60s or 70s that's meant for somebody who's younger. So you have to know this. And so our focus at Trading Trainer has always been to give people accelerator tools, things to make it so that they can do their analysis faster, spoon feed them as much information they can so that they can make the right decisions and they can do the right planning, and give them the guidance to do that. But ultimately, like all of our tools that we use for trade planning, they have these places where you type in what your risk appetite is, and and that's important, right? You be very, very careful. It's almost a crime to just take a pick blindly and try to trade it, right? Make sure you understand what it is you're doing. And right now, we just spent the first part of this show pointing out that any sort of trend trading, any sort of swing trading, any sort of directional trading is probably not going to, unless you're on an intraday type trader, that's probably not going to work for you. Any long-term investor right now, I would imagine that for the next 6 months, your portfolio is going to be stagnant, right? That is not, if you want a working portfolio, you're going to need to understand strategies that work in sideways, choppy markets.
And I think a lot of new investors seek the excitement without necessarily knowing the negative effects of the excitement that can happen, which is why on our show and in some of the examples that you go over, it is a little bit slower. It is a little bit quote unquote boring, but that's what works over time, and it's consistent, and the wins just stack up on top of each other. And really, you just want to be at the top of the mountain at the end of the year or whatever your cycle is. Even if it's slow, boring wins one after another, it's much easier to go to sleep. And that's why you created the program. That's why you have such a wonderful community. And that's why everyone throughout the week is always looking forward to getting your pick of the week, right? Getting your emphasis on specific names and opportunities.
When we started Trading Trainer, we started as a education for the full-time options trader. And what I found in the first 5 years of this company, and why we pivoted to focusing on an investment portfolio perspective and using options to learn how to invest your portfolio passive, almost like a passive trader versus an active trader. Why we did that is because after that first 5 years, I started to reach out to my first students, and I found that a good portion of them, they couldn't use the strategies that they learned from me. They got excited about those strategies, but they never could use them because it didn't match with their lifestyle. It didn't match with what they had going on then. And so I didn't want to have that happen. So what's really interesting is the number of people who wind up becoming Trading Trainer kind of evangelists, for lack of a better word, is it's folks that have tried other people's stuff. They were attracted by the shiny objects and the marketing and all that stuff, and they wind up getting burned. And then they come to me and they're like, let's do something that creates a consistent income that actually matches with my lifestyle. So it's very interesting. But even folks who come to me, they haven't done this exercise of really looking inside at what works for them. And I turn people away all the time, Sip, because I know that it wouldn't be a match for what they're looking for and what we deliver.
Well, with that being said, let's go ahead and go through an example. If anybody's watching, listening for the first time, that's kind of curious as to what AJ's talking about and in terms of his approach, the tools, the strategies, let's dive right into AJ's pick of the week. And we're heading over into the metal sector. I believe this is a newer name that we haven't covered too often, and that's El Dorado Gold, ticker symbol EGO. What are you seeing there, AJ?
I'm seeing a bottom forming on a very reliable, this is a gold company, mining company, and I'm seeing a bottom forming and an opportunity to get in on this. And so, again, I want you guys to, if you're new to these strategies, I'd love for you to paper trade them for a couple of cycles and see if these candidates would work for you. But what I'm doing here is I'm legging into either a covered call or I'm legging into a bull call diagonal debit spread. So what that means is I'm, instead of putting on the trade all at once, like a buy right or throwing the diagonal debit spread on all at once, I'm doing each leg separately. So right now we have an opportunity where we could either buy some of this stock, or we can look for a stock substitute. And so I would go at least 8 months out in time, maybe this June 2024 option. And I would go pretty deep in the money on the call side. And what I'm seeing here is, even though I don't see much open interest, I am seeing a smaller bid-ask spread. So you could probably set up this back month option quite well and get a good price for it. But you want to go far out in time and deep in the money if you're going to do that option substitute, or just buy the stock in lots of 100. And that way you would then in the future be able to sell call premium against it. And then I'm just simply going to hold. I'm going to let that initial position appreciate as far as it is. And there'll be a level. And that level for me is $11 and actually more like $12. $11.50, $12, even $12.25. If I see the appreciation go past that, not going to worry about selling the call. I've got a directional position on my hands. I'll just worry about getting out and taking my profit and running. But if it reverses sometimes before then, I'm going to go through my process of creating an income trade. This is where I'm going to sell an at the money near-term call, get some money in, and I'll buy an out of the money, maybe 3 to 6 month out in expiration protective put, which will protect my trade. And when those two trades are in place, that's when the income generating starts. I can actually, and it also is when the auto adjusting of this position starts. I can sleep really confident at night knowing that my portfolio is growing over time.
And this is a very nice price point for the stock. And so what minimum account would someone need to put this on? I mean, could you put this trade on for, $1,500 or less?
Yeah, I mean, if you use that back month option, which is a little bit cheaper, you could probably, what you'd want to do is you'd want to do a good analysis of how much risk would be the worst case scenario. So if people wanted to analyze this on their own, analyze the risk associated with doing a buy right around the $10.50 zone. You can go back and you can look at some price action. Maybe you pull up the price bar from July 27th or even go farther back. I don't usually recommend this, but you could probably go back to July 11th and you can work on and say, what would have been the risk associated with a buy right done at the money near term on that day. You can use any historical options lookup. And once you know that risk, apply that to your risk appetite. How much would I have lost in that worst case scenario, and how much am I willing to lose? And that you can work backwards into the size of your position. If you're doing a covered call, usually this could be around 30% of your portfolio. So it could be a pretty large position. If you're doing the bull call diagonal debit spread, it's probably going to be more like 10 to 15% of your portfolio. But yeah, you could do a pretty nice trade with this one.
And that was the risk that you mentioned. What would be your reward possibility that you would be looking to achieve?
I mean, if you leg into this, the beauty is you get a little bit of reward every time you sell premium, which could be, if you're using weekly options, it could be every week. But it looks like that this is cycling about once a month. And so you'd be able to pull out a nice income, probably 10% or more per month. And so you could easily double this position in 5-6 months. Again, I'm just speculating out there. You'd actually have to trade this as it's presented to you. But this is one of those positions that really looks like it would work out for you really nice. And right now is a good time to set up the initial position.
Awesome. So that's AJ's pick of the week, Eldorado Gold, EGO. As always, we're broadcasting live. So if anyone has a specific ticker that they want AJ to run through, feel free to drop it in the chat and we'll see if we can get to it. Otherwise, we've got a couple names throughout the week that we've been getting from some of our viewers and audiences, and they want AJ's input on it, and so we'll dig right into it.
I don't know if you remember, Sip, but last week we featured General Motors, and we said we would come back and we would do like a weekly update on General Motors. So I pulled up the General Motors chart, and we actually got a confirmation. So I decided to take the amount that I was going to do for that initial covering position. I decided I was going to do the stock itself, and I split that up into two different trades. The first trade, I just put a limit order and got some stock at this $33 mark. So I own the stock. I've got a break-even price on that at $33. But then I also decided that I wanted to sell some cash secured puts. So if you remember this strategy, if you guys have been with me, what that means is I've got the cash to buy the stock, but I've decided that I want to put an order in effect, because when you sell a put order, what you're doing is you're basically saying, I have the obligation to buy this stock at this strike price by this expiration date if the person I sell it to wants me to do that. So it's kind of like, it's not kind of like, it's a limit buy order at a certain price, but what's nice about it is you get paid for it. So whether the order goes through, just like any limit order, is up to the people who would be selling to me if they want to sell it to me at that price, right? But I get a premium no matter what. So if somebody does agree to sell me their stock, that's great. I'll go ahead and pay for that stock, and then I'll already apply my premium to it, so it will reduce my break-even price. And if somebody decides, but when this option expires, that they don't want to ever sell it to me at that price, I get to keep the premium anyway. So if you're planning on doing a limit buy order ever to buy a stock, consider doing it this way, because you actually get paid for placing the order. So I did a little bit of that as well at the 32 strike price. I got my premium in hand, and I'm wondering if anybody will actually fill me before September 15th.
So it's a wait and hold position is what you're saying?
Yeah, I've got the stock. So if the stock goes up, then that's fantastic. That stock that I own will go up in price. But I've also got this order that I collected a big chunk of cash on. And if it goes down a little bit and somebody decides that they'll go ahead and sell it to me at $32, that it makes sense, I'll get even more stock and I'll get it at that lower price. And I'll be able to take the ones that I bought at 33 and these ones that I bought at 32, plus I'll apply that premium that I collected, and it'll reduce my break-even price somewhere around the $32.25 mark when you apply it all together and do the math.
All right, so that's a follow-up to GM. If anybody wants to get the first half of that, head on over to the YouTube channel. I'll see if I can link it in the chat as well. We do have a nice clip on specifically this trade on the YouTube channel. So that's General Motors. Heading into our speed round, we've got a couple other names from across the country. And let's head down south. We'll start with James in Abilene, Texas, who's interested in a behemoth of a name, and that's Bank of America, ticker symbol BA.
It's actually BAC. When I put it in the notes, I apologize, because BA is Boeing. I typed that in. I was like, Boeing? No, BAC. So I apologize, Sip. I fed you some funky data. Bank of America, great stock. It's one of the bigger banks, so we're not worried about it failing, right? Because that's been on our minds for the last 6 to 9 months, is, are we going to see failing banks? I don't think you're going to see that in Bank of America. Bank of America, as you can see here, just looking at the last 6 months, the last 2 earnings, they made nice amount compared to their stock price. So their earnings per share is really good. They also give a nice chunk back to their investors in the form of a dividend. So you might not even worry. I mean, it might not be a bad idea to own Bank of America in your long-term portfolio. It's one of those type of stocks. With that said, it is in this sideways choppy pattern. I always like to go back in time. It's called fractal pattern analysis, where you kind of look at the longer time range and kind of find out when the most recent moves started. And so as I go back, here's 2 years. I can see right here, right at this moment here, we've got definitely a personality change, and it's been doing this ever since. It had this one little pop right here, but otherwise in this zone down here. I'm gonna take and remove the drawings that I currently have, because it looks like I looked at this a few months ago, and things, of course, have changed since then. So I'm going to come over here to remove drawings and clear my drawings off the screen. And I think I'm going to come back to maybe a 6-month chart, because now I know that let's go 1 year and then zoom in right about here. There we go. Yeah, 6 months. I'm looking at this and I'm seeing that we're probably forming a bottom right now. And I'd want to get some validation on that. And to get that validation, I would probably use something like the fast MACD indicator, or even use a combination of the fast MACD along with maybe Larry's Williams %R indicator. Let's put on the fast MACD. Yeah, so the fast MACD gave me an indication on this Monday, and then follow through on Tuesday that a bottom had been found. So this is a good time to be loading up either on this stock, or we can load up on the back month option. Let's take a look at BAC here. Let me use my, there we go. Yeah. I probably don't. January 2024 is not far enough out. Maybe this April or this June. I actually like this June 2024 option if you're going to think about an option substitute. There's plenty of people trading this option, even though it's that far out. What's nice also about Bank of America is that lots of people are trading the stocks and the options, so you're going to have no problem finding buyers and sellers. Maybe this 20 strike price, I would do an analysis. I would do a comparison of this extrinsic value over its mark price, and I'd be targeting around 5% or less. So if the extrinsic value is less than 5% of the mark price, that would probably be the option I'd want to choose. It almost looks like I'd be interested in this 18 strike price call. But the other thought that's going through my mind is you might want to own the stock. And that way you're set yourself up for the next dividend, because these are some healthy dividends. If you buy the stock, buy it in lots of 100 and then just let it ride as it goes up. And again, I think you'd target about $32. If it goes past $32, then just look for an opportunity to sell and make the difference between this buy price of about $29 and $32. That'll be an instant almost 10% on your money. If it falls short of $32 and starts to come back down, that's when we do our premium selling, our income generating strategies, where we would sell a near term at the money call option and buy a protective put that's 3 to 6 months and out of the money, down here near your cost basis or even a little bit lower. So I think you've got a great trade going on there. The only other thing is if you're trying to add this to your portfolio for the long term, try what we've been talking about with that cash secured put. In other words, do your limit buy order, but do it with a cash secured put so you collect a premium for placing the trade. Nothing wrong with that. You could do a September 15 option, and by September 15, you'd know whether or not you got it at the price you expected to.
All right, that's Bank of America. Thank you, James.
I like.
That's one of the bigger bank names. And so moving on from a big bank to a little bank, this is Rich in Naples, Florida, who's interested in Key Bank, ticker symbol KEY. And would we want to be weary of any of the smaller banks, in our current, interest rate cycle?
Downgrades, right? It's the mid-sized banks that have been put in a little bit of a curious or precarious. Is that the word? I don't know what the word is, but yeah, maybe they're in a situation because they were not asked to adhere to those testing rules that the big banks were. And so a lot of them got a little bit aggressive, and now they're paying the price with downgrades and junk bonds and all that good stuff. But KeyBank's been around for a while. I've actually been selling premium against KeyBank's, almost 18 years. So and again, you need to do the research on your own to see if it's the right stock for you. But I feel a little bit confident on KeyBank, but I know that I have to be on my toes and pay attention. With that said, I don't think now is the right time to be looking to do any sort of initial position. You'll notice that KeyBank seems to bottom around $9.50. We're trading right now at $11.50. It looks like it tops close to $12.75. So we're kind of in the middle of our channel. You know what's great to do when a stock is in the middle of its sideways channel is to do your preparation, to do your trade planning. This is when you can take any end of day close and you can analyze your risk, your potential rewards, and do your position sizing and trade planning. So I would spend some time right now, Rich, and I would do some planning. And it looks like it's on its way up to the $12.75, $13 range. That's when you would actually want to take the opposite position on this, where instead of buying the stock and selling a call option later, we would short the stock and sell a put option later. It creates the same income. It's just that the initial covering position is a short position instead of a long position. And that might actually be a good overall position to be in on a stock like KeyBank right now, is to bet against it rather than bet for it.
All right, that's two banking plays, Bank of America and KeyBank. And now we'll move on to our third name, which I'm surprised this is even a tradable stock these days. And this is William from Alberta, Canada, who's interested in Bath and Body Works, ticker symbol BBWI. I thought they were out of business.
Yeah, maybe, the one that I think is really suffering is Bed Bath and Beyond.
Oh, right.
But Bath and Body Works, I think they might be okay. I think they might be a little. Honestly, it's not a store that I go to, but I'm looking at it. They give their earnings, right, and it looks like they're making money every quarter, and they're giving dividends back. So they must be doing okay. Let's back this up a notch, and let's again see where things changed. Okay, I'm back a whole year. Things have been going sideways, choppy for a year. Let's keep going. 2 years. Okay, I see at one point here it up and then it came down and then it started going sideways, choppy about July of last year. So about 14 months ago. Because remember, today is the first day of September. We're going to have our market holiday on Monday, our Labor Day holiday. Okay. So now that I've got the lay of the land, it looks like we trade between 34. It's a little bit more expensive, not too bad. Between 34 and it looks like we got a spike up here to 43, but usually it stops around 40. And it looks like, again, we're in the middle of the channel. So no trading for right away. More, we're going to prepare to create a long-term position. And isn't that what it's all about, right? If we can get 10%, 20%, 30% of our portfolio into a single position that pays greater than 6% every month, isn't that a good thing? Because then you just find, 3 or 4 other positions, you get your whole portfolio working for you. If you make on your portfolio greater than 6% per month, you're going to more than double that portfolio every year. So the idea is to keep all that money working for you and become your own portfolio manager, right? You want to, that's basically why you're going to get paid the big bucks. You could give your money to a mutual fund manager who will do the same thing, and they'll keep most of the reward and pay out to you 5, 6, 10, if you're lucky, percent per year. Or you learn how to do it yourself, how you can manage your own portfolio with as little of your time as possible and keep that money working for you. And instead of giving a cut to a manager, you take all the money, which could be as much as doubling your money every few months, right? And so that's what I like to do. And I think that this is one of those stocks you might consider putting into your portfolio, but now is not the right time to start trading it. I think now is the time, just like on KeyBank, that we want to plan it out, think about it, and get ready probably in the next 2 weeks to do some trading on it.
All right. Bath and Body Works, ticker symbol BBWI. Thank you, William, in Canada. All right. You mentioned it. We're heading into a holiday weekend. With that being said, AJ, anything we should be keeping our eyes on in terms of closing out the week, heading into September? We're in a unique position where we have a Friday at the first of the month, then a holiday. I imagine next week is probably going to be pretty, the volumes are going to be increasing. We're going to be getting some action, everybody coming back from summer vacation. What are you keeping an eye on? What are your thoughts? How should we be positioning ourselves?
So September, so it has been abysmal as far as volumes are concerned summer, right? Even the VIX has had very little activity. We've been seeing the price action move, but it hasn't been a lot of VIX shares going back and forth. September tends to be, like you said, people come back, but they're trying to figure out what's going on. There's usually some reactionary moves made. So it's a little bit difficult to trade the month of September. That doesn't mean us premium traders can't trade it. It just means that it can be all over the map for directional traders. So I think we stay the course, right? And look for these opportunities. You mentioned that because September 1st today is falling on a Friday, options expiration is going to be September 15th. That's actually earlier in the month than it usually is. So we've got some thoughts. If there's any premium to be sold next week, we want to do that because September 15th will come fast. But otherwise, I think planning out these trades that are in the middle of the channel, watching our GM, watching our Bank of America, any stock that we can take a move on, we'll want to do that Tuesday, Wednesday, get that initial position in place, get ready to sell premium, and get ready to be a little bit more active as we get into the fall session.
All right. Does that mean you're sticking around town this weekend, not doing anything special with the family?
I think we're actually going to head down to our beach house maybe Sunday. But yeah, we like to just play it cool, right?
Enjoyed these last few days of the summer, the nice weather. Did you get any of that hurricane backlash? Because I know it came through the East Coast last week.
I did get not here in Washington, D.C. Washington, D.C. has been absolutely beautiful. The weather has been a little bit cooler, which is welcome because it was hot and sweaty for most of August. I haven't yet checked what happened to our home in Myrtle Beach, but I don't think my neighbors would have called me if something crazy happened. So I think we're all right.
Yeah, it's wild. We're getting hurricanes on the West Coast. Now we're getting the normal hurricanes on the East Coast. Back to school. We've got the presidential elections. We've got former presidents going up for trial. Lots of things happening in September, which we'll keep an eye on. But like you said, we'll stay the course. We've got these opportunities. We'll continue to chip away at them. So with that, anybody watching or listening, if you have any specific questions, feel free to send us a DM. Feel free to leave a comment in the chat. Someone will get back to you as soon as we can. If you've enjoyed the broadcast, hit that like, hit that follow, hit that subscribe button. We do appreciate it. We do our best to try and provide you with some high quality content with the clips and bringing up any of the questions that you guys have. So thank you for tuning in. AJ, thank you for your time. And that's all I got for us.
That's all I got. Thanks, everybody.
All right. We'll see you guys next week.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.